Hey, Mike Swanson here. Good to talk with you. Um, we're now going on January the 11th. It's Sunday, and it's a new year. And we've seen some interesting things in the stock market. And one of the themes I'm approaching this year with you is to think about risks and controlling risks and making sure you don't really suffer any big losses and any surprises that might come in the stock market. This is a little bit of a different message, I know, that than you're getting from television right now and most of the financial media, because the stock market has gone up for 5 years, went up last year, and the longer it goes on like that, the more it goes up, the more people get into the market, and frankly, the more excited everyone becomes. So last week's Investors Intelligence Survey showed a big jump in bullish sentiment among the people that they poll, while at the same time the number of people who are bearish in the stock market hasn't changed at all since months. Even though the market had a big tumble in October, there was an increased number of bears. So I think we're in a market environment where very few people are thinking about risks at all. And it's quite the opposite. Everyone wants more picks and they want ways to make more money. And that's why if you turn on Jim Cramer or something, that's all they're talking about: picks, 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 picks. I want you to think right now about something a little bit different than that. And that is controlling risks and taking a look at your overall portfolio and finding out, are you truly diversified? Because everyone knows that diversification is actually a big key, not only to controlling risks, but to generating returns that can beat the stock market. The reason why is because if you're properly diversified, you can have things that are going up when the market's going down, or if you're invested in, say, 5 different assets or 5 different markets or sectors, one sector may go up while another one goes down, and vice versa. Others are going sideways. You want everything to be kind of in a long-term upward trend, but there are times when something may fall for a few months and something else goes up and so forth. So you want a portfolio in which everything you own isn't merely going up and down all at the same time. And you have to be properly diversified to make sure that's happening. And frankly, most people don't know how to find that out or think they're diversified when they really aren't. This is a website, investspy.com. I've got nothing to do with it, but it's got a great tool that you can use to see if the holdings in your portfolio are giving you proper diversification. So to tell you what I mean, a lot of people will invest in something like a mutual fund that says it's big cap, then another mutual fund that says it's value investing, and they think, oh, I'm diversified, I'm in 2 funds. Well, no, not if those 2 funds are moving lock, stock, and barrel with one another. And this is why historically having a portion of your money in bonds does provide a diversification, but you can do more than just that. But let me show you the classic thing that a lot of advisors recommend, or it's pretty common. That's to have about 60%, let's say, of your money in the stock market. So we use SPY, the ETF that tracks the S&P 500, and 40% of your money in bonds, TLT, an ETF that's got the 20-year Treasury bond. Now, okay, we got these two in my portfolio, and I'm using the calculator, and I'm going to hit calculate. I'm going to use actually their full sample. Calculate. What is kind of diversification does this bring to me? And right here, they'll show me the maximum drawdown from 2002 to 2015. 55% the U.S. stock market. That was 2008, the crash. And TLT went down 26% from its high at some point too. If you held these, this is what I want you to see. How these two things are not correlated with one another. So SPY has a correlation of 1 with itself. 1 means it moves perfectly in sync with itself. Of course it does. But it has a negative correlation with TLT. That means when TLT goes down, SPY has gone up since 2002. Or when SPY goes down, TLT tends to go up. Of course, TLT doesn't go down a whole lot when SPY has gone up since 2002 because it's been going up year by year. But this shows you one example, and it calculates the most important figure, the intra-portfolio correlation of 0.32. So 1 would be an instance when everything in your portfolio is completely trading and syncable in each other, and 8 is getting pretty much in that situation too. You want this level to be as low as possible in order to have a well-diversified portfolio. And I think right now, the best thing you can do is take a look at your portfolio and figure out what you need to sell and reduce to get to a good level here where you're not full, where your portfolio is truly diversified. That's a rebalancing strategy. Or find things that you can add to your portfolio to lower this level. So let's see what would happen, for example, if I added GCC, which tracks the CRB index, to a portfolio. And let's say I just assigned equal weightings to them. We'll just do this really simple. What would happen? Do we go down? The interportfolio correlation just dropped, okay, to 0.26. So that would be a much more well-diversified portfolio. Now you may be saying to yourself, oh, I can't do that because I want to be all in the U.S. stock market. Well, that attitude that you've got to be 100% invested in the U.S. stock market means that the day that comes when the U.S. stock market goes down, you are going to suffer, just like people did in 2008. However, if you diversify yourself, you can get yourself into a situation in which you can make money this year, even if the U.S. stock market goes down, and even if you maintain holdings in the U.S. stock market. And that's all about controlling risk. You see, controlling risk does not mean you're giving up on getting good returns. It actually means you're more likely to achieve them year after year after year. And this is the type of mentality and thinking I want you to approach the market with in 2015 as we go deeper into this year, is thinking about managing your risk, because no one hardly is thinking about that at all right now because everyone is so bulled up. And it's when people get like that that they ignore the basics of investing, and you do not want to be doing that. So use this tool. I'm using it. I'm actually now using it to identify or figure out if I add an ETF or an individual stock to my portfolio. I'm running this and seeing, am I just adding more essentially to what I already own by buying something that's just like something I already got, or am I really making new investments that are diversified and not correlated with what I already got? And yeah, I'm eyeing things like that. But check this out. And also, if you want to hear a great discussion about what I'm looking at for the overall market in 2015, click the interview before here that I did of Ike Iosif on Friday, in which he gave me his outlook on what he thinks about the U.S. stock market this year, what he's looking for. But it was a discussion where we talked about these things together, so you can get a good feel for things, for what I'm thinking there too. And we're going to navigate these markets together and make this a winning year.